Alrighty, well, hello. Thank you for joining me. Um, I'm doing this video basically just as a backup at this stage. So if it does turn out to be the one that is uploaded tomorrow, then that is because my internet connection hasn't worked out. I've hit my fair usage limit cap or fair usage policy limit cap or whatever the case is, and I'm being throttled like a madman. My internet speed is currently very, very slow. So I am in the process of fixing it, but seeing as I did promise that I will do this every Wednesday, I need to at least have a backup in case the internet is not up to standard or up to speed tomorrow. Then at least there is something that you guys can watch and something that I have prepared for you. So I'm going to be looking at a number of different things today. Basically what I want to go through is, you don't have to forgive me, the whole idea here is to be very interactive with you during the thing. So first things first, you will notice in the comments below that there is a link to a Discord. If you don't know what Discord is a chatting tool, kind of like Slack, that gamers use actually to share text stuff, pictures, whatever, with one another, as well as do voice calls and that kind of stuff. So what I've done is I have made a Discord channel that is free to everyone who wants to join, and we'll be using that Discord channel to communicate with each other during the course of these interactive videos. So obviously this one that won't be happening because this is a pre-recording. But in future ones where my internet is not slower than a snail, it will be a nice tool for us to do. I mean, the chat facility on YouTube is cool, but Discord is better because people can, hang around in it also afterwards, post questions that we can interact with each other there. And like I said, the first video, I guess, is that I want this to be very interactive, and I want this to be driven by what you guys are asking. So there are a number of things that somebody asked. One of the trading clients actually asked. I'm not sure if we're going to be able to get to that tonight. So what would be cool is to, I've written it down. I'll cover it when it's sort of in a more interactive format rather than going through like a kind of presentation style. A little bit of content, and it's really not much stuff that we're going to be doing tonight. Well, I mean, I guess we're really going to be looking at two main things. We're going to be looking at the Dow Theory, what Dow Theory is, identifying trends, so a bit of technical analysis, and we're going to be looking at sort of the building blocks of a trading strategy. Later on, we'll break down exactly what those building blocks are. This is going to be an immense task ahead of us. To basically get through a mountain of knowledge. It's going to take a long time, so be prepared and be ready to come back sort of every week to continue learning, because there's like really a lot, and I want to be able to share it all with you. So in any case, in the description below, click on the thing, join the Discord. If you don't have it, you'll have to download it, register a profile, whatever, join the Discord and interact there. A few rules for that Discord. We're not really going to be discussing so many like trade ideas and that kind of stuff in the Discord. We're going to try and keep it focused. There is a paid Discord that customers or clients or whatever you want to use it are using, which is part of the trade idea service. But that is, that's kind of where we discuss morning plans and trade ideas and intraday stuff and whatever. The Discord for this is a free one. And that the whole purpose of that Discord is to share educational resources with one another, and obviously for me to gather information about what you want to learn, and then try and figure out how best I can bring that information across to you. So that's a long disclaimer. Anyway, let's get into what we shall be talking about this evening. So what we have first here, oopsie. I have a problem that I want on that screen. Alright, there we go. Alright, so Bruce Lee says, I'm going to remove my face here for a second because I can do that. joins the Discord, and there is the link, https://discord.gg, and some random code. So if you haven't clicked on the link, type that bastard in. So, okay. Bruce Lee says, absorb what is useful, discard what is not, and, you know, add what is uniquely your own. I've used this in a presentation before, so thanks, Bruce Lee. You're a legend. I'm not in the middle. I'm in the middle. All right. So the first thing we're going to talk about is Dow Theory, right? So Dow Theory is sort of came around a guy called Charles Dow, who lived between 1851 and 1902, was the founder and first editor of the Wall Street Journal. He wrote during his tenure at the Wall Street Journal a total of 255 journal entries or editorials or whatever you want to call it. And after he died, a couple of people sort of ganged up together or grouped together and went through his work and then presented, based on his editorials, something that they then called Dow Theory. He never called it Dow Theory because, hey, you know, it was coined after he died. But basically what Dow Theory does is it helps us to understand market trends, right? At least it helps me to understand market trends. So Dow Theory has 6 basic tenets or rules to it. So I'm just going to remove my own. I'm actually going to remove this banner as well, because, you know, seeing so many bloody banners all over the place is maybe a little hardcore. So basically, I'm going to remove myself for this as well, just so you can see what is written here. So the market has 3 movements. Okay, so the 6 basic tenets of the Dow Theory states that the market has 3 major movements that it does, and every trend has 3 phases. Markets discount news as and when it comes out. Market averages must confirm each other. So now just a little side note, the Dow Jones Industrial average, right? It's a fancy name. It's named after Charles Dow, right? So what he did is he was the first publisher of market averages. So he would look at a number of different companies and he would work out the average return for the day, and he would publish that number in the Wall Street Journal. And he would track these averages every single day, and he is kind of the father of market indexes or indices, or market averages, and thus the Dow Jones Industrial Average. It's kind of like named after him, right? Or I think he called it the Dow Jones Industrial Average. He also founded a company called Dow Jones. So in any case, or co-founded. Trends are confirmed by volume. So trends is, you know, a good indicator to see whether a trend is sustainable or not is whether or not there's volume supporting that trend. We'll get into that. And trends exist until a definitive signal proves that the trend has ended. So some people may say the trend is your friend until it ends, or whatever, which is the lamest thing on the planet, but this is where it comes from. So, alrighty, I'm going to move this screen. Oh, no. Oh, I'll just take it away when the time comes. Alright, so the market has 3 movements. The main movement or primary trend, right? I'm just going to read. This is kind of like the definition of these things. A lot of it is kind of like borrowed from textbooks or whatever the case is. So the main movement or primary movement or major trend can last anything from less than a year to several years, and can either be bullish or bearish. So this is, we see now the US market and world markets at large have had a 10-year bull market. That is like the primary trend. The primary trend is up. And these are like the big major trends that you see on the weekly candles, daily candles, that kind of stuff, or time frames. Doesn't necessarily have to be candles, but these are the big trends, right? They last very long. Sometimes they last less than a year, but most of the time they last like a very, very long time, right? And then you have the medium swing or the secondary trend, which can last anything from sort of 10 days to 3 months. So these are your correction phases. So you can have a correction of somewhere between 33 to 66% in a primary trend before you know, and that could still be seen as a secondary market reaction. So this is interesting because we often see on the news that we often see on the news that, oh, the market's down 20% from the high, oh, it's a bear market. Not necessarily. According to the original Dow theory here, 33 to 66% still makes a normal sort of bullish correction in this case, or if the market is trending down, it's in bear market mode, 33 to 66% is still just a correction, right? Because that is just a secondary trend. Now, secondary trends can last many months, but it's not necessarily, beyond 3 months is now perhaps entering into that phase of maybe it's a new primary trend or whatever the case is. Then I'm going to remove my face. Cloud. Then there is the short swing or minor movement. And there's lots of opinions here, but it varies from a number of hours to maybe a month or so, right? So you could have a move here that lasts 2 or 3 days, and then the bigger medium swing continues, and then when that primary move is over, then the main movement begins. So the theory here is that all three of these movements can happen simultaneously. So the example here is that a daily minor movement in a bearish secondary reaction in a bullish primary movement. So what's happening here is, let's say the trend is up. Market's been going up for the last 2 years. We have a bit of a bear phase. The market's pulled back over a period of 2 months, but on that particular day, the market is rallying. For 2 days the market rallies, but for 2 months the market had been coming down, but for 3 years the market is going up. So that's maybe a little confusing. So I'm going to see if I can find an example of that. And perhaps this is what we are going to use. So, oh wait, I gotta put my mug back on. All right. So the trend here is obviously very clearly up. This is Naspers, by the way, looking back to about 2013 to date, right? So the trend here is very obviously up because we have this proper sort of uptrend mode. So this is your primary move, right? Up, because that trend lasts years. Then we have inside this primary move, we have these secondary moves. So we've got one here where we have a sort of a few months of counter trend movement. So that's a secondary trend. Here's another secondary trend. There's another one. There's another one. There's another one. There's another one. So within the primary trend, which is up, there's a number of cases where there's secondary trends. This one lasts 1, 2, 3, 4, 5 months of secondary trend, and then the primary trend continues, right? And if you look sort of within the so now here we have a situation where we've now been downtrending since December 2018. December 2017 to now December 2018. And we're now obviously Jan 2019, and we are still in a downtrend. So now we're kind of in that space of like, okay, well, is this a really long secondary move? It can. There's no rule saying it can't last, longer than 3 months or whatever the case is. There's no rule saying it can't last a year or two, considering the scale of the uptrend that has lasted, the last almost 20 years, So in that context, the trend could still be up, even though we have had a 1 year correction phase, right? So we are now looking at a situation where we're asking, is this a downtrend or is this an uptrend? Blah blah blah. We'll find out. Time will tell. For now, though, the secondary trend bias is short because, or bearish, because the secondary trend here is down, and unless we break, and we'll get into higher highs, higher lows just now, but unless we have confirmation that the trend has changed, we can still assume the secondary trend is down, right? Although we know that the primary trend is up. So yeah. Anyway, now to look at the sort of tertiary trend, these are bar charts. I can use candles, but I like bars. But I think maybe I should use candles because most people like candles. Yeah, okay, fine. So these are basically, you know, just black and white rather than red and yellow. I mean, red and green. Actually, you know what? I'm going back to the bar charts. I don't care. So what we have here is, so we're looking for those really short-term moves now. So here we have a secondary move. We know that this is a secondary move that is bearish. And now we have these tertiary moves, or these short-term uptrends that come in here as part of the secondary move. So you see how they are now basically three different layers of trend analysis here, right? Or three different ways, or three different time frames in which you can look at a trend. There's the really long term primary trend, there's the sort of medium term secondary trend, and then there's the short term tertiary trend. And that tertiary trend can last anything from like a couple of days to a couple of weeks. The medium term trend can be a couple of weeks to maybe a year or two, and the long term trend is like you know, anything from close to a year to flipping, you know, 2 decades kind of thing, or longer. You know, on a long enough time frame, the trend on most things is up. So yeah, that's interesting. But I hope that explains it. If you have questions surrounding this, put it in the Discord. I'll make a little room for it, where you guys can answer questions or ask questions and stuff, and then I can maybe address it in like a follow-up video or next week's video, or give you some resources on the Discord. Ideally, I'd like to do it in a follow-up video next week, but we shall see. Alrighty, I move here. Okay, so back to the Dow Theory. One of the next tenet is that the stock market discounts all news. So this is actually something that the efficient market hypothesis states as well, which most people sort of disagree with at this stage. Some people think that it's correct, some people think that it's not, but there is a lot of agreement around efficient market hypothesis. It doesn't really work because efficient market hypothesis assumes rational investors, and you know, people aren't rational, so there's no such thing. But basically what it states is that as soon as news becomes available, prices adjust to reflect the new information. So as soon as news is out in the marketplace, the market adjusts, and it does so very, very quickly. And you might say, well, this isn't true. Well, yesterday, because this video should be up on Wednesday, yesterday Massmart got murdered, 21% down, because news came out that their you know, their sales numbers and their revenue and all that stuff, you know, their fundamentals, if you want to call it that, were terrible. And that news came out, became available to markets. It hit Sense, Stock Exchange News Service first, bang. And it was a matter of like seconds before the market started reacting. Within 5 minutes, the stock had dropped almost $10. You know, and by the end of the day, it was down 21%. So to that effect, this is quite true. So over time, if you look at that chart we were looking at earlier, that Naspers chart, for example, this does reflect whatever the market believes about Naspers at this stage, because it because as time goes by, information comes out and the market absorbs that and adjusts to that, and it does so relatively quickly. So yeah, again, questions, even put them in the comments below. That'll be cool. Also, like these videos, because the more you like them, the more I know what I need to do in order to do better. Ha! Anyway, so stock market averages must confirm each other. It's one of the next tenets. So it's a bit of an old-timey law, because if you consider the Dow lived from what, 1851 to 1902, yeah, that's like almost 120 years ago now that he died. So assuming he wrote these things like way before he died, these are some old rules, right? And back then, the US was an industrial powerhouse. There was lots of factories all over the place. They were manufacturing. This was before like the wars and stuff, so they were just pumping out, I don't know, everything. Refrigerators, cars, well, not so many, I don't know. They were building stuff. I don't know if they were making refrigerators at the time, but they were just, you know, factories all over the place. So what happened at that time is that there'd be these factories, and the only way the factories would be able to ship their products would be by rail, right? So the first indices, at least, or averages that then were created by Mr. Dow, was industrial average, or a measure of industrial shares or companies' share price performance, and a measure of transportation company share price performance, particularly railroads. So the logic was that if one sector was doing well, the other would follow. So if industrials had lots of orders, they would manufacture lots of stuff, and they would send lots of stuff on the trains, and then the train companies, the railway companies would make a lot of money. So if the railway companies were doing well and the share prices are going up because they're making money, that must mean that the factories are busy and that they're making money. And if both of these indices are going in the same direction simultaneously, then you have a situation where you have a growing economy and you're in a bull market scenario, right? And unless these two indices were moving in unison, there could be no bull market. So if railways earnings started dropping because they were doing less freight, then factories might still be pumping out a lot of goods, or they may still be their earnings might not have adjusted as yet, so their share prices eventually will, right? Because the only way that they can get their products to market was through railways. So in today's terms, that is no longer so accurate, because the US economy is not so much of a manufacturer anymore. They're more of a consumer economy now. And transportation is not as big a deal as it once was, because if you look at stuff like tech companies and whatever, you can have goods and services. Delivery is still a big thing. UPS is still a big indicator of how the US economy is doing. Which is no longer transportation, I suppose, but kind of like, well, I guess to some extent, yes, it is transportation, but you can deliver goods and services via the internet now as well. Maybe not so much physical goods, but software is a good, right? And services is kind of like, like what I'm doing, teaching stuff on the internet, right? So that might not be so well adjusted for today's modern world. But the point was, when these two markets diverge, there would be problems, right? So we have, in modern day times, different indicators that we can use in order to give us early indication, and the McClellan oscillator is something to that effect, which measures market breadth. So it basically looks at the number of shares that are rallying up versus the number of shares that aren't, or making new highs, the number of shares that aren't. Or shares that are up for the day versus shares that are down for the day, and it measures how many are up versus down, and then it sort of draws an oscillator. So I think that is worth explaining in greater detail in another video. I'm not going to get into that too much at the moment, but the point is this: these market averages are a little out of date, but nonetheless the theory is still true. You have to have a number of different industries that are interrelated, all performing similarly at the same time, and if there is divergence between these industries, then you are potentially in a situation of in a spot of bother. Right, then trends are confirmed by volume. So when this basically says that if a market move happens in a particular direction, it is helpful if volume is increasing with that move. If volume is decreasing with that move, then it could be an indication that the move is unsustainable. So markets can move on low volumes for like totally random reasons. Okay, so one of the reasons that's cited here is that you can have an overly aggressive buyer or seller. So for example, some guy from a hedge fund or from a unit trust or from an offshore ETF or whatever, offshore ETF gets like $1 billion invested into it by a whole bunch of people in a very short period of time. Like emerging market ETFs, for example, people are just pouring money into it, and those guys now have to go out and buy stock because they're mandated to do that, and they just come and they just buy everything in sight. Or there's a redemption, somebody, a whole bunch of people withdraw money, and similarly these guys are mandated to now sell these shares. And they just come and just sell anytime somebody puts a bid on screen, they just get hit because these guys are forced sellers, right? that might not necessarily be done. So yes, there's big, players in the market and stuff, but it could be just one guy, literally, or one bank, or one ETF, or one fund, or whatever it is, pushing a market in a direction. And then you'll see that on the chart in terms of there's relatively low volumes. So I'm going to keep using Naspers as an example if I can. You know what I'm going to do? I'm going to zoom out. Wait, I'm going to actually move to a weekly chart and see if I can find an example. So so it's not so easy to find the examples of these things, especially when you're looking so far back in time. You know what, there's a nice example of the on the S&P 500. So let me see if I can quickly open that platform. In any case, okay, so to get back to the point here, the general belief here is that when markets are moving in a particular direction, and volume supports that move, that you have that's kind of the true intention of the market. So if the market is moving higher, or a stock price is moving higher, or whatever the case is, and the volume traded in that stock is continuously increasing, or staying sustainably high, or slowly increasing as the price is going up, that kind of shows that the market is convinced that that is the general direction. It's the view of the whole market. As the price is going up, more and more people are joining in and saying, like, this is the direction that the market ought to go, and they're taking a view that this, it's going to continue to go up, so more people are willing to participate. When the market is moving higher, for example, and volume is dropping off, that means there's less and less pressure on the buy side. Less and less people are participating in this rally, and that could mean that the market could potentially turn around. And the same applies obviously on the inverse. If market is coming down and volumes are increasing as the market is falling, then we have a situation where the market believes a particular move. Sorry, I'm getting distracted because I'm doing too many things at the same time, trying to open another trading platform. So if volumes are increasing while the price is falling, then that means the market is convinced that that is the general direction of the market, or the longer term view that the market might be taking. If volumes are tapering off while price is coming down, then that could be indicative of a potential bounce in markets. And we're going to go back to the screen. So, oh man, okay. Yo, the struggle is real trying to get this damn platform going. So that one, it's after midnight, so the thing is down for maintenance. So I'm gonna use good old investing.com. So in any case, you can see all my fancy icons at the bottom. Discord is this one. Hey. Let's look at the futures. So, all right. So, actually, I'm not going to move on from this until I have shown you an example, because I'm resolute in my determination to say the same thing a million times in a different way. Redundancy, king. Sorry, so I did get throttled. I don't know if I told you guys that. Oh my goodness, it is one of the most frustrating things I've ever been through. I haven't had slow internet in a mighty long time, and now suddenly I've got like slow internet, and it is killing me, man. US 500, S&P 500. No, why doesn't it not show volume on the indices? Goodness gracious me. I'm actually going to switch to the screen so you can see what I'm doing. Cow. Let's see if DJI is going to work. Is it? Yes. Haha. All right. So Dow Jones Industrial average. Thank you. So what is sort of concerning here is if you see this movement here. So at the bottom we have. I have to do that. At the bottom we have like our volume indicator. Okay, so I've got like a, well, I don't know if this is standard or if this just remembers my settings, but I put like a 20-day moving average on it so that you can see volume spikes. You know, if you have exceptionally high volume or higher than average volume stuff, it's helpful to know. In any case, so as you see here, the market is falling down. We have this steady increase in volume, right? And then we have it sort of peak here when the market bottomed. What has been concerning is that as the market has rallied up here and recovered here, volumes have actually sort of come down on average, right? You can even see that average 20-day sort of moving average on the volume has been coming down as the market has been rallying, which is concerning. Even here during this sort of period, you can see average volume kind of tapered off, which then led into a downward movement with volume lifting up, right? So that kind of is what this rule is trying to say. Like, if you don't have volume supporting the direction of the trend, then it is likely that that trend may turn or come to an end. To show you an example of it working really well, this is, I keep forgetting that I'm still on the screen. Here we have sort of volume. You can see this average is kind of going up, and this trend is just sustainable. And you can see this volume is just sort of, okay, every now and then it dips a little bit, but on average, this moving average is pointing higher and higher into this rally over here. So that's kind of like, I suppose, the most practical example I can find of how that works. So coming back to, I keep forgetting that I gotta put that thing off because it's a fucking banner city. Yeah, where are we? So the trend exists until definitive signals prove that they have ended. So the trend is your friend until it ends. It's the lamest saying ever, but man, it's true. Okay, so trends exist. You know, things go up and down. Noise happens. The news screams about rubbish. Donald Trump tweets, but trends exist despite all of this. Okay, and markets may temporarily move in the opposite direction of a trend, but they will soon return to the primary trend or the secondary trend. So remember, primary, secondary, tertiary trend. So there's a primary trend. Temporarily the market might move against that, but it will eventually return to the primary trend until we have proof that the primary trend has changed, right? And the trend, the overall trend, should be given the benefit of the doubt during these reversals. So if you have a primary trend that is up and you have a secondary trend that is down, Naspers down for 2 years, the primary trend should be given the benefit of the doubt until we have definitive proof that the primary trend has ended and a new primary trend has been formed, which is now a bear trend, right? So determining whether or not that reversal in the primary trend or in the secondary trend is kind of where technical analysis comes in. So there's many different ways of studying it and whatever, and this is kind of where this is the difficult part. You know, trend analysis, people think it's so easy, you just look at the thing as it's going up, but the truth is, if you just follow the trend all the time, you would never lose money, right? So determining what the trend is actually pretty tricky, considering that there are 3 different ways or 3 different interactions or 3 different directions that the trend could be going in any given time on any, you know, on different time frames. So the primary trend is up, secondary trend is down, tertiary trend is also down, or, you know, tertiary trend is up or whatever. They don't always have to be opposite. They can move in unison, they can move opposite each other. It can be relatively confusing, and this is what technical analysis really is sort of about, is to try and study trends and turning points, right? So there's many different theories that try and explain this. So one of the things, I'm going to make my face go away, pow. One of the things here that sort of helps me determine the trend, and is a sort of general rule of thumb, I suppose, is to look at whether or not the market is making higher highs and higher lows. So this is a very easy way of determining what the trend is doing. So hike and dropping. So as you look here, the market sort of comes up. This is in an uptrend. The market sort of comes up, makes a high over here, pulls back, makes a low over here, pulls all the way back up, makes another high, pulls back, makes another low. This high is lower than this high, so it has made a higher high. Yay! Smiley face. Higher highs for winning. And when you have a higher low, you have a really weird situation here. So I'm going to, how do I just reset? How do I make it go away? No. I don't know what I'm doing. Okay, well, all right, no. All right, I wanna, I made it hide. I don't want to make it hide. Anyway, whatever, maybe it's better that I made it hide. Actually, I'm gonna fix it. Hang on a second. We're gonna go back to the left screen, so I can fix this damn thing. So I can fix it. I want to fix it. All right. Okay. I want to fix it. Pow, which I have. So, all right. So, the point is, in an uptrend, you have higher highs and higher lows. In a downtrend, you have lower lows and lower highs. And you generally have two consecutive of them. Okay? So, when there are two consecutive highs and lows, you can say that a sort of trend has formed. Now, keep in mind, this might be a primary trend or a secondary trend or a tertiary trend. If you want a primary trend, so in the case where you're looking for a trend reversal, what you have to look for is, has the market, if the market has been making higher highs and higher lows, aka trending up, that trend in the primary time frame, or in the time frame that you're looking for in terms of the reversal, has that taken out the previous low and made a high which was lower than the previous high and made another low. So to give you an example, I'm going to draw. So let's say, for example, you have, I'm going to draw a nice fancy block here because that's where we're going to do it. Pow. Okay, so we have a sort of primary trend that's going up. It's doing that, and we want to know now, when is this market turning? So my view here, and I read this somewhere, is that once we have two consecutive lower lows and lower highs, you can even maybe ignore that one and say 3 consecutive. Okay, so let's make that 3 consecutive lower highs and 2 consecutive lower lows, that we have now got a downtrend. Okay, now we have to try and determine, is this a secondary trend, or is this a new first or a new primary trend? And that is like the $1 million question, right? If we can figure that out, this whole game would be a lot easier. But until we then have and then the premise of Dow Theory says that that is now the new trend. The new trend is now down. Until we see it take out this high, make a high, make a new low, and make a new high, right? So you need to have confirmation that trends are changing. So what I would say is, like in a situation like this, if I see sort of 2 or 3 consecutive lower highs and 2 consecutive lower lows, I would say that, okay, the primary trend has now formed a secondary downtrend. And the premise here is, remember, the market can pull back 33 to 66% before we can say that, hey, this primary trend is in trouble. So we then are looking for higher lows, higher highs again before we can say, okay, the primary trend has resumed. Alternatively, if the time frame of this downtrend starts to exceed maybe a year or two, then we can start looking at, okay, well, look, maybe the primary trend is down. The difficulty is, though, that on these long time frames, the primary trend is actually kind of always up, because even the crashes don't really last, that long. Maybe they used to many years ago, like the Great Depression stuff was very long, but these days he says, like he's an old man, they don't last much longer than sort of 2 or 3 years. If you look at what 2009, 2000, or 99, 2000 kind of busts, those are all very short term or short lived, but brutal nonetheless. Anyway, so this is what our plan is to do. It's this side: get good, and we have to study in order to do that. So the last sort of thing that I want to go through, I haven't actually been watching the time, so I don't quite know how long I've been at it. But the last thing that I want to go through is a sort of example of what the building blocks are of a trading strategy. I'm playing with washing pegs. I don't know why, but I am. So the building blocks of a trading strategy. What we have here is basically, I'm just going to move this a little up so that you can see what is cooking over there. All right, okay. So building blocks of a trading strategy. What we've got here is sort of an example. I've used this example in some of the Power Hour stuff that I've done. As an example of a trading strategy. So this is the kind of thing that you may want to print out and stick on your desk or stick on your wall or whatever the case is. It's kind of like a flow chart, like a process that you can follow, that you know that if you follow this process, this is the way that, or the things that make up a strategy, like the building blocks of it. So in later videos, I think we're going to have to definitely delve into this a bit more, because as you can see, what I've done here is I've broken it up into different things. So this is a wave trading strategy, because every strategy needs a name. It doesn't, but whatever. It's up to you. I specified that it's long only, and it works on the hourly and daily time frame. So already we have kind of like a time frame rule built into just even the name of the thing. All right, so we know that we're going long only, and we're going daily time frame. Then we've got a couple of different things going on here. We've got risk management elements, we've got trade identification methodologies or methods, and then we've got an instrument selection or universe creation element as well. Okay, so the risk management elements here are sort of broken down in a couple of places. So the first thing when we look at, we have rules for our strategy. So building block number one is what risk management rule are we using? So here I've specified a 25% exposure rule. There are rules based on volatility. There are rules based on 2% risk of your total capital, or 1% risk of your total capital. This particular one is based on never having more than a certain amount of exposure, or never having more than a certain amount of exposure to any particular instrument. It might also make provision for adding into trades or whatever the case is. This particular rule does not, but like there's many different ways of skinning the cat here, which is maybe not a nice thing to say because cats are cool, but many different ways of managing risk, and this is kind of just like one of them, right? And what you can see here is the rules are 25% exposure, and then later on I'll talk about stop losses again. So in any case, so first rule is how are we managing risk? Second rule is what is our trade identification methodology? So I'm saying a swing trade based on ABC principles. So that's a very specific kind of set of rules. It works with moving averages. It works with sort of fan lines. It works with a little bit of Elliott wave theory mixed in there. It's got a little bit of Fibonacci stuff in there, and it basically works on like ABC patterns in the market. One day is one day I'll explain that stuff in sort of more strategy focused stuff. What I'm trying to do is I'm trying to break these videos into sections. So this is the strategy portion of the video. So building into this, explaining strategies, I just need to first explain how strategies are put together, which is why we're doing this, right? So, okay, so swing trade based on ABC principles. So that is our trade identification methodology. Then the next point we have is what are we trading? So this is you'll see I specified there universe shares only, which is real fancy because all the shares are in the universe. I mean, the universe is everywhere. But basically what I've done here is there's a number of different ways in which you can create an investable universe, or basically just a list of stocks that you can that you are allowed to trade in, and you can use a number of different methodologies to come up with that list of stocks. So there is, you can say only top 40 shares because they have good liquidity, and they're well covered by analysts, and they're always in the news and whatever. You can say you only want the top performing shares in the top 100, or you don't care what about the liquidity in the stock as long as it's outperforming the top 40 index, or the all share index, or whatever the case is. So there's thousands of different ways that you can select stocks. You can look for things that have purely fundamental elements to them, where you have earnings growth, you have positive ratings from analysts, you have dividend growth rate, you have debt to equity ratio things that you're looking at, and earnings growth rate things that you're looking at. You can build a model where there's a combination of a number of things. So it is a relative outperformer of the top 40. It has a solid set of fundamentals, low debt to equity ratio, or ever increasing dividend and earnings growth, as well as proper liquidity in the market, or in the stock market. So you can trade in and out of it, and is in the top 40. So you can build a model that encompasses all of those different things, and it doesn't even have to be South African stocks. It could be any stock anywhere in the world. So what you are trading is very, very important. A lot of people think that, oh, well, I'm going to trade Forex because, like a chart's a chart. I used to say a chart's a chart, but I don't believe that anymore. I think that you have to be very selective of how you trade specific things and why you trade them. So what is nice to do, for example, is if you, like a top-down approach where you look at different methodologies, or you look at different stocks in a particular methodology, where you kind of on a weekly or a monthly basis, you go and you find out, you do some work and you find out which stocks are the strongest performing shares on the market, which are relatively outperforming like everything else, and which are the weakest performing shares in the market. And then you can then watch the Aussie, for example, or the top 40 index, and say, like, if you have a situation where you're entering into a primary or a secondary downtrend phase, you only want to go short, and you only want to go short these stocks because they are the worst performing stocks in the market. When the trend on the Aussie is up again, and it resumes the primary trend, or whatever, you use your higher highs, higher lows things to determine the trend is up, or it's a breaking channel line, or whatever the case is, whatever your trigger is, or your turning point is, and that's again technical analysis study, to tell you that the trend has changed. You then know, okay, I want to go long, and I only want to go long these 10 stocks, so I'd only look for long opportunities in these 10 stocks. And if there's nothing, I'm not going to go trade Blue Financial Services or whatever, because it's not liquid enough. Or I'm not going to go trade XYZ stock. I'd rather be short FirstRand than Standard Bank, for example, because FirstRand is underperforming relative to the financials index, and Standard Bank is relatively outperforming. So you want to be short the weakest along the strongest, right? So you know which ones you long and short under which conditions, and that is kind of falls into your investable universe. And it's a very important thing that I think people, I don't know if they think about it or not, but I think it's something that we have to consider, right? Anyway, okay, so moving on. The next portion of this thing here is entry, exit, and stop loss criteria. So what we have, entry and exit criteria, is kind of leans on the trade identification methodology. So this is a little bit more detail. So you need a kiss of a moving average, a stochastic through 50, and a break of resistance, right? So these are very specific rules for very specific reasons. and we'll get into them at a later stage. But basically, what this is this is sort of an elaboration of the edge methodology, or an explanation of the edge methodology. So it kind of, in plain language, says to you what is the method that I'm using to identify an edge. Now remember, an edge is nothing more than the probability of one thing happening over another is higher. That's said really badly. An edge is nothing more than the probability of one thing happening over another. Whatever, retrading in the zone. Okay, I can't remember what I said. But an edge is basically just a set of variables that tells you, like, the odds of this happening is higher than the odds of that happening, right? And that is an edge. So that is what we use to make money in the market. So we know that there's a 3-to-1 risk reward and a 50-50 chance of being right if we use these variables every time, and we just play when just those variables are present, and over time we will make money. If we do it 1,000 times, we only get it right half the time, and we only lose 1 and win 3 every time we're going to make money. That is what an edge is, right? It gives you that comfort. So your entry and exit rules are part of your edge, right? Or your edge identification. And then your stop loss rule is obviously part of your risk management. So just below B, or a 912 EMA crossover, or a trend line trailing stop. These are all different stop loss methodologies. Hard stop and 2 different trailing stop methodologies that you can use. And there are obviously tons and tons and tons more, which we will cover over time. Here we have sort of 3 more headings: must-haves, nice-to-haves, and watch-out-fors. So must-haves are kind of a few more details around your edge. So what I've said here is validated wave pattern, multiple time frame trend, confirmed trend with a whole bunch of different technical indicators, and a price pattern that we have to have. It has to have a primary trend line. There's got to be a high probability setup, a price target that we can easily work out using Fibonacci stuff. It's got to have relative outperformance of the top 40, so it has to be within our universe. It's one of the things that that we specified as part of our edge identification, or instrument selection. Universe creation is kind of interrelated, if you want. Nice to haves. So these are things that are not necessarily must for us to enter into trades, but they are definitely supportive, so they help with conviction, right? If they're not present, we might have a setup at low conviction. If they're there and we have a setup and they're all present, then we have like super high conviction as well. And this is also just a mixture of different technical indicators and or price formation movement stuff. And this all kind of falls into edge identification, and it's just a few more details that you can print out, stick in your desk, and say, like, okay, remember, this is a checklist. This is like a thing that you go through from top to bottom. Do I have risk management in place? Do I have a edge methodology or a system that I'm using? What am I trading? Okay, what is my entry? What is my exit? Where is my stop loss? Do I have all of these things? These things are nice to have. How many of them are present? How many of them are not? Then more risk management stuff, follows again. Then, like, what are the things we have to watch out for? It can prompt you to exit the trade, or it can prompt you to not enter the trade, right? And these are like significant resistance levels, bearish candle formations, falling volumes in an uptrend, bearish divergence, which is another sort of technical stuff we'll get to later, rising volume in a downtrend, unbalanced volume, moving average crossover. These are all different things that can either prevent us from taking a trade or take us out of a trade that we're already in, and it's just basically falls within the risk management stable. And I think, I don't know how long this has been. We have been going for 54 minutes, which is a long time. And I hope with everything that is in me that this thing is actually going to upload in time, because currently my up speed is, I kid you not, half a megabyte per second. So if I start uploading it now, it may be done by next year sometime. So hopefully it's done by 7 tomorrow night, and hopefully even better, my internet is sorted and I can do all of this live. and answer questions and all sorts of things, and not just ramble endlessly in the middle of the night into a light that I've set up so that I don't look all dark and shady. Yeah. Anyway, so I'm running out of things to say. So anyway, okay, so we have reached the end. I would like for you to subscribe, because once I have 100 subscribers, I can get a custom URL for the channel, which is cool, and it doesn't have to be like this more of a long link. It can just be like Harenia or whatever, and like the video and join the Discord and leave comments and ask questions, and come back next week for more if you want to and if you like it, and join the Discord. Tell me what you want to learn, tell me what you find valuable, tell me what you didn't find valuable, give me feedback, and hopefully over time, well, absolutely over time, these will get better. So happy trading.